Don't be this guy when you lose a trade.
Ah, headshot.
First thing of becoming a profitable Forex trader is having a great strategy, and today I'm going to show you a triple EMA strategy that has been proven over time to be very efficient and successful. Enjoy! So the triple EMA strategy is great, and we need to add the 3 indicators. So go inside the indicators tab and type in moving average exponential. It will be under the built-in section and triple click on it. So now we need to change 2 exponential moving averages. So go inside the gear icon. These will be the settings, and change the length from 9 to 20. Choose a different EMA. Go inside the settings icon and length from 9 to 50. Click OK. So now you should have 3 exponential moving average lines on your screen. Now the best way to trade exponential moving averages is to find an actual trend. Now to not confuse you and find the trend properly, we need to hide the 20 and 9 exponential moving averages and keep only the 50 running. The 50 will be our trend direction line. Now head over to the monthly time frame and see what's going on. As you can see, it has been trending towards the downside and recently has crossed with a bearish engulfing candle. Although it's not yet closed as a bearish engulfing candle, it's attempting to go down, and that's pretty much good enough for this strategy. On the weekly time frame, we can see the same thing. Exponential moving average line is well above the candlestick, which shows bearish pressure. On the daily time frame, we can see the same thing. 50 exponential moving average over here, trending down nicely. Now coming back to the 4-hourly time frame, we need to reactivate our EMAs. Since we have established already that everything is trending down because our 50 moving average is well above all of these candlesticks. So currently the market is trending down, and it has been on the monthly, weekly, daily, and even the 4-hourly time frame. So now we need to find a way to enter the market. And as you can see, recently we broke out from a supported zone. This area was clearly supported. We can see every time it touched these area zones, went towards the upside before breaking through with a bearish engulfing candle. We need some sort of area sensitivity that was broken with a bearish engulfing candle, push exhaustion, push scenario, and we are shooting towards the downside. So this could be a great trading opportunity. We select now the short position and click over here. We're gonna have our default settings 44.44. That is not what we want. We want to have our stop loss above the 50 moving average, so around 80 pips is the usual, and take profit should be 160 pips for 2-to-1 risk to reward ratio. So now look, this is fantastic. Even now, if the market decides to pull back, we're gonna have the 50 moving average over here blocking it, and 50 moving average reacts as a what? Resistance, right? It's a moving resistance line. So if the market decides to pull back towards the upside, very likely the exponential moving average or moving resistance is gonna pretty much bounce off and go towards the downside because it's a lagging indicator, right? Candlestick first move, then the exponential moving average is probably gonna meet around this area zone and shoot towards the downside. So if that even happens, we're probably gonna have just a pullback before it continues to go down, because we just made a new lower zone over here and because everything is trending towards the downside, right? Simple. So now let's take a look at what would happen if we placed this trade, right? So we click OK, boom, it's going down and keep on making bearish engulfing candlesticks. We can see over here, bearish engulfing candle, yet another one over here, bouncing off near the moving averages, which is nice. That's what we want. And as you can see, it continues to drop down and we would be making a bunch of pips. So as you can see, this strategy would have made you easily 144 pips in this case, and you wouldn't have closed your trade because you have the 9 exponential moving average line. If we just remove now the 20 and 50, as you can see, it has been following the 9 exponential moving average. Every time it touched, it went towards the downside. So to money manage correctly, we need to move our stop loss to entry. Once we reach, let's say, halfway point, move your stop loss to entry, maybe close off 50% of your trade and continue running the trade until it crosses the 9 moving average. It never crossed in this case, so we are expecting to continue going towards the downside until it actually crosses the 9 moving average. You don't want to close off your trade because pretty much you can gain so much more money by holding the trade, because you never know how long the trend will continue. For all you know, this trend could continue to maybe 1000 pips, and this has happened multiple times throughout Forex history. So if you're still a little bit unsure how to use the exponential moving average, let's have a look at the buy-in trade order over here. So the same scenario, everything is trending up on the monthly, weekly, daily and the 4-hourly time frames. We can see the nice cross of the moving averages over here with a bullish engulfing candlestick. Now, this is pretty much the opposite of what we discussed. We need to find a bullish engulfing candle in this case to enter. So since we have found one now over here, what we need to do is just enter the trade and see what's going on. So look at this. We played the tool once again. We are going towards the upside. And look, we would have reached a ton of money. You could have potentially even made more money, because remember, you only close off your trade once it crosses the 9 moving average. So imagine we would have trailed our stop loss over here. Once we reach, let's say, halfway point, we do the stop loss to entry, so we don't risk anything anymore, and we trail our stop loss level under the 9 moving average. So if you're confused, let me just remove these 9 moving average over here. Let's see what's going on. So after it crosses, which it does over here, boom, this is the pips you would have made. Around 130 pips in this case, 140 pips. So you could have potentially done 160 pips and be happy, or technically risked it a little bit more for potential bigger push for 200 pips, 300 pips, 400 pips profit, who knows, 1000 pips. The trend could continue on for months. So you could have potentially risked that and you would have made, around, let's say, 140, 137 pips in this case, because it crossed the 9 moving average. Once it crosses the 9 moving average, that's it. You close off your trade. You don't want to be in the trade, because potentially the trend is now changing direction, and this is what the 9 moving average is telling you. Your 20 and 50 exponential moving averages is basically a moving support zone. That's what you want to call it. So it pulls back, goes up, pulls back, goes up. But the 9 moving average, especially once you reach your maximum level, this is where you use the 9 moving average to close off your position. If you're not happy with the position, let's say you only profited 40 pips or something, you still want to profit more, maybe don't look at the 9 moving average. Use the 9 moving average once you've reached your maximum level, let's say 100 pips or 200 pips or something, and then you want to maybe trail a little bit more and maximize your pip gain. This is where you use the 9 moving average and continue the trend on. And once it crosses, as I said, crosses the 9 moving average, boom, you close off your trade, you are done, and you take your profit. Now make sure to combine this triple EMA strategy with fundamental analysis. There was over 13,000 large speculators over here, and on November 9th it decreased the number by 1,000, which means very likely it's going to be a nice sell-off opportunity for you guys. And we got a bearish engulfing candle once again. Triple moving averages are also above. What does it mean? It's likely it's going to be a sell, and boom, is going down nicely. And now, where would you close off your trade? You would close it just around here when it crosses this area zone. So let's have a look. Boom, we close it off over here. So 92 pips profit. We just followed the 9 moving average. Obviously, it's very likely going to bounce off here, and this could be as well a re-entry opportunity. Now let's say we close off our first trade over here for 90 pips profit, hide the 9 moving average. Now there's going to be a re-entry opportunity potentially if we get a bearish engulfing candle. Now let's see if we do get one. Did we get one? Yes, we did. Look, bearish engulfing candle bouncing off the 20 and 50 exponential moving averages. It's a entry opportunity once again. Now open the 9 moving average. Look at this trade. We can do the 2-to-1 risk to reward ratio, but probably we're going to close it off a little bit earlier because of the 9 moving average once again. And look, boom, that's okay. Look, sometimes it happens, and I don't want to show you just fluff, you know, sometimes this happens as well. And look, boom, it crossed the 9 moving average. We would have probably closed, if you're late, you would have probably closed it over here. Let's say if I was late, 10 pips profit. That's still good, right? That's still money you could have made, 10 pips profit, but attempt was there, and you could have potentially even closed it over here somewhere if you was happy with the profits. It really depends how you money manage your trades, but trust me, this triple EMA strategy does work, and I recommend you guys check it out. So if you like strategies and you like live trading, make sure to subscribe to my channel and check this video out. It's pretty damn good.